Danielle, you're not a financial advisor, but you consider yourself an educator. And last year you released Shareclicity, a simple approach to share investing. How has sharing investment information changed in the last year and since the acceleration of online tools like social media?
Hi, Lilde. Well, actually, I've been involved in equity markets since 1985, both professionally and personally. So the first point I wanted to make was the fact that we've had a massive bull market since the March 2020 sell-off when the corona crash happened in share markets. And because you're seeing such strong performances in equities and cryptocurrencies, what it does, it attracts a lot of new players into the market. And inevitably, when you get all these new commentators in, a lot of them have not lived through and experienced the cycles of some of the more experienced investors and commentators. And the thing that I would say is that with all this money going in that direction, inevitably it's going to attract more people in the social media context, selling information or disseminating information on investing. And the problem is, if you don't have the experience, sometimes there could be not necessarily misleading information, but I just think that bull markets attract all this exuberance, and it's the same in the social media space. And that's what I have seen over the last sort of 18 months. And it includes people writing books as well. Suddenly there are so many books on how to invest in the share market.
Absolutely. So much content everywhere. Now, your book aims to educate and inform both new and existing investors. When investors are faced with so much information online, how do you advise they disseminate between credible and aspirational information?
Really, really good question. The first thing is that all new investors and existing investors have to realize that they have to continue to educate themselves about what's going on in the markets they invest in, particularly with shares. And that means that reading financial news is very important. But when you go actually onto some of these social media platforms, be it Twitter, FinTwit, or Instagram, you need to understand that all the commentators come to the party when they share their information with a different reason for why they are doing it. Some of them are educators and they're usually fairly upfront about that, but they all have different styles of management. Some of them are what we call value investors, and they invest in cyclical stocks, and they tend to be cheaper. And then there is another form of investors called growth investors. And Kathy Wood from ARK Invest is one of the most famous. And she invests very heavily in innovative technologies and the world changing. And the reason why it's so important to understand and differentiate between what the commentators are saying is because there are overarching factors, macroeconomic factors, which will impact on each of those different types of asset classes. So what I say to investors is never stop learning, never stop reading. Be a little bit cynical about things, and remember you are in a bull market and you need to understand the reason why the commentator is very positive on a stock, because often they are long the shares themselves.
Very true. So, Danielle, do you believe regulating social media platforms to keep them safe for investors should be the responsibility of the platforms, governments, or users?
Again, a really, really good point. What we tend to see in terms of regulation is it takes a pretty big disaster for regulators to move in a more heavy-handed approach. I think there is regulation within the social media context. If they see people doing the likes of pump and dump strategies, they will come and do something about it. But with all investing, it really is a case of buyer beware. And I think it's incumbent upon everybody that goes into financial markets to actually do some homework and try and understand their appetite for risk. Like, what are they putting their money into that they could potentially lose down the track? And again, when you have these incredibly exuberant bull markets like we have at the moment, where most assets are going up, it's very hard for people to differentiate and visualize a world in which it doesn't go up every day.